argues the Fed will likely have to cut rates as a result. Joining us this morning, longtime market vet, Wharton School professor Jeremy Siegel. Professor, good to have you back. Thanks for being with us.
Happy to be here, Carl.
I took note of your comment last week. Why would the Fed come out and make a move like a cut, knowing that this policy could be undone in minutes?
Well, you know, the Fed can be much faster moving, and I've often advocated them to be much faster moving than they did. They can make changes intermeeting. There's nothing that restricts them from doing that. And, if Trump, in fact, does reverse himself, they can reverse themselves also. They don't have to be a slow-moving boat like the Titanic, like people think. They can move quickly, and they should respond. The interesting thing is that some of the near-term data might not be that weak because we know there's a lot of advanced buying on the tariffs. So we may have to wait a few weeks or even a month before we really begin to see some of that data that he is looking for. And by then, that I'm not saying it's too late, but that would hamper his ability to offset the coming recession.
Now, you have your reaction function on the Fed, I would argue, can be a little hair trigger. There was a time not long ago you were calling for intermeeting cuts, right? Are you going that far?
Well, not so far at this point, because we haven't seen that weak data. But I mean, we have a big inversion of the term structure, and I think the May meeting should be in play. Most people are dismissing that. And I absolutely think it should be in play, because the truth of the matter is inflation signals are of less utility to the Fed now, because how much is it going to be tariffs and how much is it going to be excess demand? Well, it's not going to be excess demand. And that's when the Fed should really tighten, is when there's just too much spending by consumers and businesses and investors. That's not going to be the source of the increase. A supply shock. And a supply shock should not be reacted to. And that's why I'm saying that I think that May should be in play.
I just want to cut you off because we're seeing some pretty dramatic action in the market right now. The Nasdaq is now positive. The S&P, after going into bear market, has just gone positive as well, and the Dow has wiped out more than 1,000 points and is now positive as well.
I don't know.
It was down 1,500 at the lows.
I don't know if there's been any specific news.
Well, I mean, we are getting some headlines from Europe that I'll just mention. Hard to know if this is moving or not. But basically, Europeans are saying that they want to negotiate. We've offered to the U.S. 0-for-0 tariffs for cars and all industrial goods. A range of tariffs is hitting 380 billion euros worth of EU exports are facing 70% of our total exports are facing tariffs, they say. They say that is an important source of income.
There's
so defending that.
There's also this ABC headline that tariff legal challenge could be filed as soon as Friday. That's just a flash.
Maybe that's it.
Yeah.
So what do you do, Professor? Do you sell the bounce if you're as negative as you seem to be about this policy and the fact that they've dug in?
Yeah, but if this policy is, if this policy is going to cause this sort of reaction, then you're not as negative as that. So, listen, I'm sitting tight because these tweets, these movements back and forth, I mean, this is a human error. In my opinion, on the part of the president. I mean, it's not a feature, inherent weakness in the U.S. economy. One could have argued in the financial crisis, our whole financial system was unsuited and rotten and all the rest. That the pandemic was a unique thing, and who knows how bad it would be. This is something that, one or two men are pushing onto the economy, and they can reverse it. And the long run of the U.S. is as strong as ever.